All right, my friends, we're going to do a real live case study of a reverse mortgage here today. I emailed my man Don Graves over at the HECM Advisors Group, HECM Advisors Group.com, and I'll put a link to the show notes. And I said, hey, can you send me an illustration on a reverse mortgage? And I'm going to give you a sample client, which would be me. And he said, sure. And he sent me to it. He sent me one, which I'll share with you here right now. I'm going to talk to Don next week, as a matter of fact, or this week coming up. And hopefully I'll get him on my podcast at some point too. Look, I got nothing to sell you. I don't get paid on any of this stuff. I frankly could care less what you do. I just don't. But at the end of the day, I find it to be the days of looking at simple retirement planning solutions like a 4% rule or having 65, taking your 100 minus your age in bonds. So those days you just can't do that anymore. And the reason for that is twofold, threefold, 20-fold. But let me just start by sharing with you the 10-year treasuries at 1.74. So the 4% rule is based on the presumption of many things. One is that the presumption was real world scenario, which is what makes it wonderful. But the scenario was back then we had significantly high inflation, significantly higher yields on bonds than we do now. And we haven't had high yields on bonds for a long time, haven't had high inflation for a long time. There's also premised that there was a time where you could buy the S&P 500 with a price-to-earnings ratio at 8, as you could in 1982, which meant you had a significant high dividend ratio with a low PE. Those days are just gone. So in 1982, you had significantly high dividend rate, not payout, but just dividend yield, low PE, high bond yields. I mean, that was the best of both scenarios. In 1966, it was different. It was going into a high inflation but high treasury bond rates as well. And now it's low inflation, low treasury bonds with high PEs and low dividend yields. I mean, the whole premise of things like the 4% rule or your age minus 100 is your bonds. It's just you got to look at it differently. And on top of that, as Wade Fowler and I were talking about the other day, you have to look at the America of the last 100, 150 years or so as the exception, not the rule. And that's why I found it interesting about Wade did his studies on the 4% rule internationally. I haven't read that. I'm sure I have read it. I just don't recall it off the top of my head, the article he had written for the Journal for Financial Planning. But you have America way out here and everybody else way down here. And yet we're using way out here as a premise of retirement planning projections. I don't like that. Now, look, I'm not a freaking negative Nelly or like, oh, we're all going to die. I'm not like that. But, at the end of the day, I think we have to use all the tools in the toolbox. And if 2/3 of retirees or soon-to-be retirees' biggest source of assets of net worth is their homes, not to incorporate that, to at least to have a discussion about it, I just don't get it. I don't understand, especially when you have bonds at 1.75 before taxes and inflation. It doesn't make sense to me. So, look, and you might have a pension. You might have all the income you need from your pension and or Social Security. You might not have any debt at all. And that's completely fine. You might have $1 million saved. You're spending $40,000 a year on that, plus your Social Security and pension, and you're only spending $50,000 a year. Completely fine. I got no problem not using a reverse mortgage. But for the bulk of us, that's not the case. And so I think it's prudent to look at it how using the equity in your home would fit into a financial plan. I don't understand this animosity towards these things. It's weird to me, but. All right, so let's dive into this. So my man Wade, he sent me this illustration, and the sample is my wife, me, my wife Charlotte, and me, and we have a $250,000 home, and we have $50,000 a year left on the mortgage. We're paying $750 a month is our mortgage payment. So what Don said, he didn't say it, but he emailed me this to me. He said, okay, here we go. You guys, you're supposed 62 because that's a minimal age you can use to borrow a reverse mortgage. Somebody's got to be at least 62. Your home appraised value is $250. He's going to use a 3% annual appreciation. I'm going to drop that down when I show you the spreadsheet I developed. Total balance to be paid off because remember, your reverse mortgage can't be subordinate. It's got to be first, so it's got to pay off any other debt that's outstanding. An amount to be the amount the borrower plans to pay back. So they're saying you're going to pay $750 a month back, $9,000. A year until this sucker's paid off. Okay, so basically what's happening here, if we have also on top of the borrowing this $50,000 to pay our first mortgage off, we also have a $53,500 line of credit. And if we go to reverse mortgage calculator from retirement researchers, we can say our home appraised value is $250,000. We're going to use that. We're just going to default to the 10-year LIBOR, the lender's margin, and that's the interest rate right there, the monthly premium plus the 10-year LIBOR plus the lender's margins. That's going to give us what, 5.5. Age of is, we're going to say 62. We're going to say 62, and our principal limit factor is 41.7%. All right. So what that simply means is we can borrow up to 41. I expect it. I'm not. That's new, I think. All right. So anyway, we're going to say at the end of that, we're going to say our principal limit factor is about 41%. So if we come back here, we have $250,000, and we have 41% of 250. That's 0.41. That's going to be $102,000 we have total. And so we take this amount here, our total loan balance, plus this amount here, will give us the amount that we can borrow in total. Now, what we're going to do though is we're going to finance the closing costs as well. All right. So let's see if he shows a close. So we're using an expected interest rate assumption is 4 1/8, which is a little bit lower than what Wade is showing here. And that, again, this is all just for illustration purposes only. It doesn't matter. Wade's showing 5. He's showing 4 1/8. And what I've done here is Wade's showing 5.5 when you factor in the 50 basis points for the mortgage and premium, the mortgage insurance premium. Anyway, FHA expected interest rate assumption for this illustration, 4 1/8. We're going to say in my spreadsheet, we're going to say 4.75 or 4.65 just to show what I'm talking about. All right. So our loan balance is $62,000. How do we get $62,000 as a loan balance when we're only borrowing $50,000? Well, so if we take the 62 plus the 53, we have a primary limit factor, PLF, of 115,000 divided by 250. So in this case, I guess it is 46% is, yeah, right. 46% is they're giving us in terms of the total loan, the total principal limiting factor, PLF, 46%. Wade's got 41%. So again, it doesn't matter. I mean, it's not 100% equity. That's all there is to it. But a lot of people get caught up in that and say, "Whoa, $12,000 of closing costs. That's 24. What is that? 24% or something like that of the closing cost fee on the loan balance." Well, no, I get that, but what they're missing is no matter what happens. Let's go back to Wade's calculator. You're always going to have 2% of the appraised amount. Always going to have that. So you're going to have 2% of the appraised amount no matter what. That's for the mortgage insurance that the HUD uses to guarantee a non-recourse loan. Non-recourse loan simply means you will never owe more than the appraised value of your home. Ever, 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 ever. You will never own more. Now, for the HUD to be able to guarantee that, they got to charge the borrowers the money. The borrowers aren't borrowing against the credit amount; they're borrowing against the complete appraised amount. So that's $5,000 right out of the gate. Initial mortgage insurance, $5,000. It's non-negotiable at all. In this case, we've got other closing costs, appraisal, titling, $2,500. You have a loan origination fee. So if you have, let's say, what's the name? Probably, we'll see here. We're gonna put $4,500 as your, right there. So we got $4,500 as a loan origination fee. $2,500 as initial closing cost, other closing costs, your appraisal, titling, and whatnot, plus a mortgage insurance. And here's the $12,000. I would go in there and argue for a lesser loan origination fee, but I appreciate what Don's showing. He's not minimizing the closing costs at all, not in the least. So he's saying at the end of the day, it's going to cost you $12,000 to borrow $50,000, and what some people say is essentially a 24% fee, but it's not. They're missing it. So I want to share with you real quick what's happening here. So essentially, we're paying the $750 a month. We're paying back. So after 7 years or so, this guy will be paid off. 8 years, this guy would be completely paid off. So we no longer have the loan balance. It's completely paid off. But notice now what's happening here. It doesn't really show you, but the $62,000 is growing with that 4.125 interest rate that they're using right here. They should make that a little bit bigger. I don't like that, but either way. 4.125 is interest rate plus the monthly, we got 0.5% is your mortgage right here, mortgage insurance premium, or your monthly insurance premium, which again is used to support the government's insurance fund that provides guarantees to both the borrower and the lender. For all loans issued at the present, it remains permanently fixed at 0.5%. All right, so we got all that stuff in there. So I'm adding that 0.5% monthly insurance fee to the complete interest rate that they're charging. So the total fee to me would be 4.1625. So with all that said and done, we'll have this guy paid off in, let's see, 8 years. So essentially you're paying $750 times 8 times 12 times 750. We'll pay back $72,000 over the course of, what is that? $72,000 over the course of 8 years on a $50,000 loan. All right, so then it's done. We're done with it. We don't have any mortgage payment anymore. It's done. But we have this line of credit that's more than double. It's more than tripled. Look at that. So the line of credit was $53,500 when I was 62. When that loan is paid off, it's $174,000. Look at that. $174,000 is the line of credit, because every time I make a loan payment back, I'm building up my line of credit. So let's just say the strategy would be, if I'm planning on working until I'm 70, just use that for an example. Man, go ahead and take the reverse mortgage and start paying that sucker off to get it down to open up more of a line of credit. And on top of that, you take the reverse mortgage when you're 62. It makes sense, because you're paying the 2% insurance premium on the appraised value of the home. So it's going to cost you $5,000 at 62. If you wait till you're 70, that 2% is going to cost you more than $6,000. Does that make sense? So you pay it now, and basically it's like you're hedging. You're prepaying what you know for a fact will cost you more. On top of that, the line of credit won't be $53,500. It will grow to $162,000. It's tripled, more than tripled by the time you're hit 70 years old. So essentially what you've done is you locked in the lowest possible rate on your home assessment without question on the closing costs. You paid that guy off. You took out your first with this reverse mortgage. You paid it off. Yes, it probably would cost a little bit more in interest, but look at that line of credit you can now tap into. It's 3 times what it was back at the start. So now what we do is we take 326, which is our value at 71 of the home, subtract that by 174. So we have $152,000 is still our outstanding equity that the reverse mortgage can't touch. All right, so here we have 152,000. Divide that by 3. What's that? 326. Is that what it was? Yeah. So that's 46%. We still have 46% that we can tap. We have 54% we can tap into, is what I'm trying to say. All right, so now here though, 250, we have 62 plus 53. Divide that by 250. Yeah, so here we only have 46% we could tap into. So here we got 54% we can tap into. Here we got 46. The older we get, the more we can tap into our reverse mortgage to pay the bills. Do whatever we want with. Again, it's tax-free. Tax-free. So now the line of credit, by the time I'm 80 years old, is $265,000. So we take 425 minus 265. We still have $160,000 of equity we can't touch. And that's the interesting thing. If you go down here, it's always right about $150,000 of equity. We have full 589 minus 440, $150,000 of equity. So what happens is the line of credit is always growing at a certain amount of money that you're not touching, as long as you don't touch it. So there's always going to be the same amount of equity, roughly, relative to your ability to borrow from your home relative to how much you can't. Does that make sense? So you're never tapping into the entirety of the home, not even close. You still have $150,000 you can't touch. All right, so let me show you my spreadsheet here, what I've done. All right, let me pause real quick. Actually, before I do that, let me show you the other thing that Don showed me. So here, we're not even paying the money back. We're just saying we're going to borrow $53,000, our $50,000 pay off our mortgage. We're not paying anything back. Our line of credit is $53,000, not paying anything back. What is the line of credit growing to? And so here you can see it's growing. Again, if we fast forward till I'm 70 years old, it's at $77,000 now. Now the question is, how much do I have outstanding? I'll share with you just a second. So here we have $24,000 more as a line of credit amount I can borrow against than I did before. If I do as a 10-year payment over my life, I can get $400 a month out of this guy without tapping into, without any issue at all. I get $400 every single month for the rest of my life tax-free. That's basically $5,000 a year. All right, now, what will that come out to be? So here's where I did the loan amount. So again, if we look at, right here, our loan amount, that's our line of credit amount. So when I'm 70 years old, our line of credit will be $77,000. But when I'm loan amount, when I'm 70 years old, it'll be $89,000. Does that make sense? So basically, we're saying we start with $62,000 as our loan amount, and by the time I am 70, it's $89,000. So it's grown 27 divided by 62. It's grown by 43%. What has the line of credit amount? Well, the line of credit was 53, and now it's 77 minus 53 divided by 53. That also has grown by 45%. All right, so that's what happens. The line amount is growing by this. The loan amount is growing by this. I mean, what I should say, they're growing together, the same thing. The line amount is growing, the loan amount is growing. The line amount is growing, the loan amount is growing. The line of credit amount is growing just at the exact same amount as the loan amount. So if we go here, this is my spreadsheet. By the time I'm 80 years old, I owe $139,000, which is more than twice of what we borrowed against it for sure. And that's again at 4.625 is the interest. I owe $130,000. My home value, I'm just using 2% appreciation, is we're 80 right here, is $357,000. So I still have, I think that's my equity. Yeah, I still have $217,000 of equity. I still have $217,000. I haven't come anywhere near tapping into my interest, into not having enough money, or the loan being worth more than my mortgage, than my equity. Not even anywhere near that. My line of credit amount here, I got 117. Again, I'm just using a couple different things. What did I use that there? That doesn't. Yeah, that's not gonna be right because we got. Wait, how much? Oh, when I'm 80, excuse me, I'm 80. I'm like I said, when I'm 80, I've got my line of credit 117. Let's see what that does with these guys here. When I'm 80, he's got 122. So I'm basically spot on. Well, that's pretty cool. I'm basically spot on with what the Don's was. Off by a couple bit. That's fine. So what's happening here is, yes, my loan amount has gone to 139. My equity is still, I still got tons of equity, 217,000 equity. I'm only using a 2% adjustment, or 2% appreciation as well. And my line of credit has gone, to 117. So my line of credit has more than doubled as well. So my loan amount has more than doubled. My line of credit has more than doubled. My equity has stayed pretty doggone close to where it was before, in between, in this case, 188 and 217. Now watch this though. This is what I thought was pretty neat. Oops, let me go back here. Right here. All right, so here. What happens if I'm 62 years old, all right? I'm not going to pay off the mortgage. I'm just going to let that sucker sit there. So I'm going to use my 62. I'm going to invest it in the market. And I'm not going to do anything with it. What happens to my portfolio? So again, my loan has cost me 4.625%. I expect to get 7% rate of return on the market. What happens? So I'm paying off my mortgage, my $62,000 mortgage. I know for a fact by the time I'm 80 years old, I will owe $140,000. I mean, it could change because of the interest rates. I'm just using that for an example. I know for a fact at 4.625, by 18 years from now, I'll owe 140, we'll just say. I know for a fact if I get 2% appreciation on my home will be worth $357,000. I know that for a fact. It's all closing costs and everything. I also know for a fact my line of credit will grow to $117,000 by the time I'm 80 years old. That means I have access to another $117,000. But my $62,000 at 1.07, if I believe that the market's going to do better, and this is the old-fashioned use the equity as a hedge against inflation or a hedge against low interest rates or something like that. By the time I'm 80 years old, which is 20, I'll have $209,000 in my brokerage account, 209. So not only do I have $117,000 I can tap in, I got $209,000 I can spend as well. Again, the $117,000 that I got was tax-free. That I can have access to is tax-free. This will be maybe not tax-free, but in terms of it'll only be a little bit on terms of long-term capital gains because I've been adding to the cost basis because of dividends I've reinvested. So in this case, I'm actually ahead by $69,652. And it's simple. It's just real numbers. It's just basic math. I'm saying I'm getting 7% over here. I'm borrowing 4.625 over there. Thus, if I borrow against a home equity reverse mortgage to pay off my $50,000 loan, I'm borrowing $62,000 to pay off a $50,000 loan. And I could take that $62,000 that I was going to use to invest before, but now I'm going to invest it in the market. That will be worth $69,652 more. I guess you'd actually say we probably should change that to $50,000. Actually, keep it even, Steven. It's still going to be worth $29,000 more because there's no closing costs. I should have done that. So I'm borrowing $50,000, right, and it's going into the market at 7% a year, which means I'm not which means I'm not borrowing. So I'm borrowing $50,000, but it's going to cost me $12,000 to borrow $50,000. So my total loan amount is going to be 62. The total loan amount is going to cost me 4.625% a year, which means after 18 years I owe $139,000. But instead of using that $50,000 to pay back the mortgage, I'm just dumping in the market and I'm getting 7% a year on that, which means at the end of 18 years, I have $29,000 more to my name on top of the fact that I still have a $117,000 line of credit. I hope that makes sense. So let's just say we only get 6%. What does it look like there? 1.06. And oops, we want to do this. Let's see. 1.06 by the time 20 comes around, I'm ahead by $2,813, and I still have a $117,000 line of credit there. So if I only got 6% in the markets, I'm still ahead after 18 years. Not by much, I grant you, but still I am ahead. If I got 5%, 1.05, I imagine I'll be short quite a bit here. Let's see. How long will it take to, I'm sure, yeah. So if I only got 5%, I'll never make it back. I'll never make it back. If I only got 5% in the markets, by the time I'm 95 years old, I owe $275 on that $62,000 loan I took out, and I only have $250,000 in equity, or well, I guess an investment account. So I'm lost $25,000 there, but I still have $480,000 in total value of my home. So I owe $275. I still have $480,000. I could have used 231,000 as my line of credit. Yeah, I could have tapped into 231,000. Either way, I'm down $25,000. That's not going to make or break me at all. That's only if I get 5%. Well, let's just say, what if I get 8%? Just for giggles, let's say 1.08 boink. Let's say that, and where would I be by the time I'm 95? I'll have 358,000 more. By the time I'm 20, 18 years go by, I'll have 60,000 more. So shoot, I'll have more money in this after a year. That's 9 after 7 years. All right, so that's how that works. Now, obviously, there's a lot of things to concern yourself with. The interest rates could change. The house appreciation could change. But the thing is, if the interest rate changes on the debt, the interest rate changes on the line of credit too. That's the crazy thing. Anyway, so there you go. Now, I don't know how else to say that about the home equity conversion mortgage. Now, we haven't tapped into the line of credit. I'm just showing you how it works because we haven't tapped into it. But that's if you have a first mortgage, you hit 62, you're like, I'm going to keep paying interest on the first mortgage, and I'll pay it off in 5, 6, 7, 8 years, or take a home equity conversion mortgage, pay that sucker off, use that savings I was going to use towards paying off the mortgage, and I put it in the market because I no longer have that debt, at least a monthly cash flow outstanding. You can see, there's a pretty good chance you're going to be better off for it. I don't know. You have to figure it out, but that's even including $12,000 of closing costs, which is on the high end. You can easily get these guys to cut back on the closing costs and origination fees and whatnot. So anyway, hope this helps. Love to hear your comments on that. Put a thumbs up in the show notes. Don't forget to subscribe. Don't forget to hit the bell to be notified, and we'll see you next time. Love to hear your comments on this. We'll see you next time.